In this video, I'm going to be explaining the one candle that I trade every single day aligned with my IPD FEG model that has made me over $318,000 in the last 8 months. As always, here's proof of all of my payouts through my actual accounts. As you can see right here, we have Lucid with around $80,000 in payouts in the last 8 months, Apex with another $70,000, and then going through Alpha with another $80,000, and then my Top Step account with a P&L of over $90,000 as well. Here's exactly what I'm going to show you in this video. I'm going to start off by showing you 2 examples of my model. Then I'm going to show you exactly why this candle works, the 3-step model behind the actual move, and then go into live examples that I've traded this week. So first, starting off with proof. As you can see, this is a trade I took today, making $1,300 right here. And the same trade with execution marks right here. And this was another trade that I took Wednesday of last week. Now, the first thing that you need to understand is that the market only moves in 3 phases. These 3 phases are going to be accumulation, manipulation, and then distribution right here. And this all consists of one main reason, which is going to be fractals. So in every candle, you're going to have the body, you're going to have the open, wick high, and wick low. Market opens and accumulates right here, as you can see. This is creating liquidity on both sides of the market, so buy side liquidity and sell side liquidity. Then you're going to have manipulation move down, creating an imbalance, and the manipulation is a Judas swing, which sweeps one side that takes people out of the market. And then you have the actual distribution phase up to the high of this wick. And the thing that you have to understand is that this happens literally on every single time frame. This can be a 1-minute candle, this can be a 15-minute candle, and this can be a daily candle. But the one candle that I trade every day is going to be the 4-hour candle, specifically at 10 a.m. And the reason that I trade this 10 a.m. candle is because this is the time that London session overlaps with New York session, which both of these have the highest volatility out of any sessions. And then the main reason that we are waiting for this manipulation move before the distribution is because institutional banks need stop orders to actually fill their millions of dollars worth of orders. So what do we need to wait for? We need to wait for a group of traders to get stopped out right here. Then we can enter with the banks towards any highs for the highest chance of winning a trade. So now that you actually understand the reason behind why the market moves, why we actually trade with the institutions, and the 3 different types, how it goes from accumulation, manipulation, and distribution only, now we can go into the actual 3-step model to the entry. But also, if you want an entire guide on my entire model, there's going to be a free PDF in the link in description. This is the exact 3-step model that you need for an entry. Number 1 is going to be your high time frame bias. You need to determine whether you're going to or away from internal range liquidity or to or away from external range liquidity. And this is exactly how you're going to determine it. On the daily, 4-hour, and 1-hour time frame, you need to determine whether you're going to a fair value gap, which is going to be towards internal range liquidity. And the way that you're going to know this is if market has already taken out some sort of buy-side liquidity and now next needs to go to an internal range swing before it can go externally again. And then it's the opposite for external range liquidity. If you've already entered that internal range liquidity move, which is going to be your fair value gap, then you know you need to have an external range liquidity move swing to the upside, taking out some sort of liquidity. So once you have your high time frame bias, that's when you need to align it with your morning power of 3. And this red line is going to represent market open at 9:30 a.m. So pre-market, you're going to want to see accumulation, a Judas swing happening between 9:50 and 10:10, and then your entry towards the manipulation and distribution move to the upside. And this is going to be accumulation, manipulation, and then your distribution move to the upside right here. Now, it's important to note that between 9:30 and 9:50 a.m., this is exactly when you're going to need to have your manipulation move, taking out some sort of liquidity. And an extra bonus thrown there is going to be that you wanted to enter into a 15-minute fair value gap that's inside of a discount. So if you remember, you can only enter longs if you are in a discount. You never enter longs if you're inside of a premium for a bullish example. So now that you understand the power of 3, let's go into the actual entry model so you know exactly when to buy. And this entry model consists of 3 things. Step number 1 is going to be that you have to wait for that Judas swing between 9:50 and 10:10 a.m. macro time, so you can have this sell side liquidity taken so you can enter with the banks. Step number 2 is going to be aligning it with a time frame, right? Time over price. This is important because you can only enter this trade in this model between 9:50 and 10:10. This is the only time. And why is this important? This is super important because this is when two of the most important times overlap. As I said before, this is exactly when we have that New York and London session overlap. And that's also macro time, so it is the highest probability with the first 10 minutes and the last 10 minutes of every hour. And then step number 3, now that you have time aligned with price, is going to be your actual entry model. So if you have your normal accumulation, and then you have your manipulation move, which is your Judas swing, and then your distribution phase, right? You're going to have your fair value gap down here, and it's super important to note that you are going to need a change in state of delivery. And the way that you actually use this entry model is that you need that fair value gap going through the high of the change in state of delivery, and you also need it happening on NQ and ES at the same exact time. And what do I mean by that is I mean that the fair value gap and the change in state of delivery has to happen on both of these at the same exact time in order for you to enter. Now let's get rid of everything. I'm going to go into live trading examples of this model. So starting off on the daily time frame, you could see that we had just came into this fair value gap on the daily time frame, right? We came into it here. Now the next draw, since we have already gone to internal range liquidity, is going out towards external range liquidity, and that is the reason I was bullish for the day. That doesn't mean you need to target this high. It just means that you're bullish, that your daily bias is going to be bullish. Then from there, just drop down into the 1 minute time frame, go to market open, and you can see that we have pre-market accumulation right here. We have market open described as this line right here. We have our manipulation phase coming down, taking out sell side liquidity as this low right there, sell side liquidity taken. And then during actual macro time, which you could see 9:50 to 10:10, which I'll mark out with this line, what do we see, right? We see our change in state of delivery, which is going to be this high. And then we have a fair value gap going through that high right here. As you can see, this candle comes and closes above that high. You also have an extra little confluence in there as an inversion fair value gap right there. So based off that, you can see I entered 9 contracts the second that that candle closed. And side of that fair value gap stops at the most recent swing low and targeting super easy profits. As you can see, this first swing high was one of my take profits, and then the candle closure of 9:30 a.m., which is going to be relative price that you actually, which is fair price once price comes up here, which is the reason I got out right here, as you can see. And then market started chopping up, so I completely got out of the position there. Now let's go into the trade that I also took last week. Going into the morning right here, this is going to be our accumulation zone pre-market, and then we're going to have market open at 9:30, which is this gray line. We have our manipulation phase to the upside, and then from there you literally just wait for the change in state of delivery, which is going to be this low with that fair value gap going through it. Right, you could see this fair value gap candle closes below this low. That is going to be exactly when you enter short, putting your stop loss at that high and targeting sell side liquidity. And as you can see, this was a perfect power of 3 of accumulation, manipulation, and then distribution phase using the IPD FEG entry model as your actual entry. Okay, getting into the first trade, this is going to be a long example. As you can see, we have already had market open right here, which is going to be this black line, as you can see with the date right here. And we had our accumulation zone. We have already manipulated down, taking out 15-minute sell side liquidity. And now I have my high that I need to get taken out as my change in state of delivery. We have an extra confluence as an inversion fair value gap. And as you can see, we are inside of macro time, which is 9:56. As you remember, it needs to be between 9:50 and 10:10 in order to enter a trade. So As you can see, this is, since I've been doing this for a while, I can already tell that this is where a setup is forming right here. So just with that being said, let's erase that. I will play the video and I will put the playback speed at 2. You can see I set up my brackets already. I have my limit order ready on this side right here. And pretty much all I'm waiting for is this candle closure. And then I need this candle to close as well, because it can totally just come back down and there not be a fair value gap. So the important thing is you have to wait for the fair value gap to close in order to actually enter the trade. So you can see I draw out that fair value gap right here. And I am going to wait to see what happens. You'll see I'll put a market order right here. See how it says market? Let's change the colors. As you can see, I entered a position right there. Make it red. So entered my position right here inside of this fair value gap with that change in stated delivery, and I am inside of the market now. Put my stop loss at this most recent swing low, and I have a super easy target. I think this was like a 1.2 risk to reward on this short-term buy-side liquidity, and then fair price, which is going to be the close of this 9:30 a.m. candle right here is my final take profit. But I'm going to fast forward a little bit because I was in this trade for a little while. I have fast forwarded, and now you could see first contract taken out right there. So take profit number 1 at this buy side liquidity swing high, and I took 4 off of that position. As you can see right here, I was checking my P&L right there. And let's get rid of all that. And now I move my take profit, and I have the rest waiting at this swing high up there. I'm going to fast forward a little bit until that gets hit so you can just kind of see what happens right there. All right. Now this is the high that we're waiting to get taken right there. And you'll wait and see it get wicked up into for a easy 1 to 2, making 1,300 on this trade example right here. And then right there, you could see another order taken off right there. I still have 1 trailing, but I do end up just taking it out because we get chopped up, right? See how much we're chopping up right there? I just exit and I don't even want to enter right there. So quick review. We had our review, right? We came into the morning. We had our, are we gonna be able to draw this out or no? We had our accumulation zone right here. We then manipulated down, taking out sell side liquidity, which is going to be that line right there, right? And then inside of our macro time, which is going to be 9:50 to 10:10, we had an entry model with the fair value gap right here. Let's see if I could draw that out. Anyways, right there, and then the change in state of delivery going through that high right there. So I'll show you example number 2 right now. All right, so this right here is going to be example number 2. As you can see, I started this a little bit late. I've already entered the market, but I'm going to show you exactly what I saw for this day. Right here, we have our accumulation coming into the morning. Right here. Accumulation. We have our manipulation leg up. And then now we are looking for shorts down towards these lows. As you can see, my take profit is right there, right? So we have the fair value gap right here. Let's see if I can change that color. No, that's fine. We have a fair value gap right there with the change in state of delivery going below this low. So if I play this out, you could see we start to go up inside a little bit more, and then we start coming down. And let's pause this. So we have the entry model if I go over that again, right? We have our accumulation right here. We manipulate up, and then we have our fair value gap right there with our change in stated delivery happening at the same time. Enter right here. And pretty much just targeting easy lows, which you can target this low or this most recent swing low right here, right? And then let that play on. And bam, there weren't any executions, but you could see that I am in the market right there and right there. So let's wait for that to get hit right. There you go. So got hit, and I hope this actually showed you exactly how this trade worked. But thank you for watching the video. I'm going to have 2 extra videos put up on either side of the screen right here. Go ahead and watch them to learn more about my IPD FEG model and the exact strategy that made me over $300,000.